Since its inception in 1966, the credit card has added more and more features to its proposition, whether that be protection, rewards, balance transfers, contactless, you name it. As a result, it's begun to stand for something different to each and every one of us. And that's very much played into the hands of the debit card, whose simplicity and control in the fact that you don't have to remember to pay it off, you can't spend money you haven't got, and all your spend is aggregated in one place, has meant that the debit spend has really started to outpace that of credit. So the credit card industry remains really at a critical juncture. And today I'm going to try and explain some of the key trends that are influencing the credit card market before aiming to put my hat in the ring to make some predictions about some of the ways the business models are going to evolve. I must stress that everything I'm going to say today is very much my view. They're not the official views of Lloyds Banking Group, and it would be remiss of me to really share our overall strategy with you. So hopefully it'll be interesting and insightful, but I'm afraid they're not. I'm not going to reveal our crown jewels just yet. So we talk about challenges in the credit card market, and this survey from Lafferty, who talked to a range of issuers globally, and then produce a view of the profit pool in each country, gives us a good indication. It's not 100% accurate in my opinion, but it gives a very good indication of the overall curve of profitability in credit cards. And what you can see is that in 2010, the numbers really dipped right off. And I think people were predicting that this was the start of a very, very difficult and austere time for the credit card industry. But in fact, in 2011, as you can see, things started to really uplift. And the view of Lafferty is that that trajectory will continue to move in the right direction. I personally think that that's not going to happen just by sitting still, and that we have got a challenging time ahead, but I'm confident that the credit card industry will continue to move in that right direction. So let's have a look at some of the key trends affecting the card industry. So the first and foremost that really has had the biggest impact has been regulation. And there are probably three key pieces of regulation that are impacting the card industry. The first being the Department for Business and Innovation and Skills white paper, which came out in 2010. And in there were really three clear call-outs. One around allocation of payments, the way credit card companies generate and charge the interest rate on the different payments on a card. And that's had probably the biggest impact overall on fee income. There have also been changes in how cards can apply limit increases to existing customers, and also the methodology in which minimum payments are calculated and then paid. Then, towards the end of last year, we've had the ICB paper on banking. And again, three core call-outs. Generally, they're affecting the banking industry as a whole, but there are direct implications onto the card industry. So the first around loss absorbency, really calling on all banks to make sure they hold at least 10% of core Tier 1 capital. And in the case of lending, that they've got they've got the capacity to absorb at least 17% of risk-weighted assets. So what does that mean? That means that the CEOs of these banks are generally focusing on one thing, return on equity. Bob Diamond, if you ever read his analysis on Barclaycard, talks about that really quite a lot. So he's very overt. Return on equity is something that the CEOs are constantly looking at. And that's meaning that the card department's under a lot of pressure to prove the value that they're bringing to the bank, not just as an individual standalone unit, but more holistically. So I think we'll start to see a greater trend in banks as to how we understand and measure our customers in a more holistic measure. It's also leading to some consolidation. So I actually believe, well, I've heard anecdotally that MBNA's primary reason for divesting their UK operations was to do with the need to hold more capital. Then we've got retail ring fencing. So that's going to have impacting on essentially the way retail banks and investment banks are currently managed, and that'll have an impact on accounting policies. In some instances, this may even lead to certain card departments being outsourced. In the same way that today Santander UK don't actually run their credit card division, that's actually run by the headquarters in Spain, and all the UK does is a sales and marketing arm. And we at Lloyds Banking Group, we run a number of card portfolios for other issuers, so notably Sainsbury's Bank and SAV and Aqua, two near-prime providers. And then the final one is about increased transparency and competition. And so that's resulting in greater scrutiny from risk departments. I think the appetite for risk has gone down. When one's thinking about what acquisition offers they can offer, what spend and offers, one has to be slightly more cautious about how one goes about that so they're not being deemed to be irresponsible. And also really demanding greater investment tools for customers, whether that be improvements in statementing, but other tools to help them stay on top of their spend, mobile apps, SMS, etc. And then the final area, which Alan's already mentioned in his introduction, is around, which come from our friends in Europe, is really around interchange. We've got the green paper that was released in April. Yes, it's very much a consultative paper at this point in time, but I think the sentiment in there is very much looking at what interchange levels should be set going forward. And more recently, we've seen the EU General Court judgment on multilateral interchange, which was really quite dare I say, a damning indictment on the way interchange is currently set across the European border. And the OFT have made it abundantly clear in some of their recent papers that they see a direct read across to the UK market. So I think as an industry, we're watching with bated breath to see where the OFT might go with this. So you can see there is a potential for reduced interchange, and that might lead to things like reward products becoming less prevalent in the market. I'll flick through economic and social. So very quickly, we've seen a decline in UK household borrowing, so that's seeing a reduction in appetite for debt and therefore products like credit cards. We've seen a fall in real-term income. So last year, real-term income fell in the UK by 3.5%, and therefore seeing a reduction in one's ability to spend. Low interest rates continue to really benefit the card industry because they're lower funding costs, but who knows when and how those will go up. And then finally, the risk of a double dip would very much impact impairments if that was to materialize. On the social side, there's very much a clear follow-through. So this reduced appetite for debt has resulted in reduced appetite for cards, overdrafts, and loans. And on the flip side, we've seen a very interesting insight where there's been a massive uplift in interest for coupons, deals, and rewards. And the research that I've seen says that this is very much almost the affluent market that are more interested in this than others. So again, in terms of driving spend and reward, it's a very interesting area. And then finally, interaction from social networking, and I'll come back into that, but very much becoming more and more pervasive in the way that we all do business. Technological. So we've already heard about the growth of commerce and the views that Visa believe 50% of all spend will originate from a mobile in 2020. And we're increasingly seeing spend move from the PC to the mobile. There was one stat that really called out to me, which came on Black Friday. Black Friday is the American equivalent of Boxing Day, so the day after Thanksgiving when all the retailers have their sales. And in 2010, 3% of all transactions took place on a mobile device. In 2011, that had increased to 9.8%. So a massive uplift, and I think that trend will continue to accelerate. And that's seen likes of O2 with their O2 wallet, Monetize with their Simply Tap proposition, a number of companies really seeing this opportunity in m-commerce alone as something that they can really own and carve out for themselves. And as I say, I think it's a hugely exciting area, and we'll see a lot of opportunity in that. Contactless and mobile. We're going to be hearing a lot about that at this for the rest of the conference. I won't go into this in much detail, but obviously the aim is to displace cash. It's been a little bit slow to take off, but we're definitely beginning to see some momentum. And we at Lloyds, along with our partners at Visa and Samsung, will be making some more announcements about our Olympic handset and our desire to create more awareness of this technology, utilizing our sponsorship of the Olympics in the coming days. We've already heard from Rob around how alternative points of sale payment methods are becoming more and more prevalent. And that, to be honest, is a big threat to us banks, because if it's not our plastics that are being used, we lose that relationship, that touch point with our customers. Being relegated to the role of just facilitating the funds to the likes of PayPal and others is obviously not the ideal place for us to be in the long term. And then finally, card acceptance. We're going to hear tomorrow from iZettle. I think this is a hugely exciting technology and will open up a raft of new opportunities for card payments. And personally, I believe this technology will do more to displace cash than some of the other technologies that we have, displace checks than some of the other technologies that have been discussed in the past. So a quick recap then of the outlook. Would anyone like to take a guess as to where they think interest income is going in the next 5 years? Anyone? Up, down, stay the same? You think it's going up in the credit card industry? Okay, I personally think it's probably going to stay at a level playing field. And the reason being is that APRs at their highest they've been for some time, and the fact that we're seeing the overall balances on cards shrinking means there's less opportunity to grow. Interchange. I won't ask you to guess because I think you've already heard from my sentiment. We think that the continued regulatory pressure and potential action from merchants and others means it's inevitable that interchange will reduce in time. Fee income. Anyone want to hazard a guess? Fee income, where that's going? Up? Well, I think traditional fee income will actually continue to erode. And as we've seen from all the regulation, that there is definitely less opportunity to grow that. But as I'll come on later, I think there are other opportunities in this space. Impairments. So impairments is very difficult to predict. It's very much linked to the economic conditions. A double dip would spell bad news, but there has been a lot of tightening in the industry. And so as a result, I think the books generally are quite robust and will stay fairly level. Funding costs, well, I think it's inevitable that funding costs will fall. It's just a question of when, not if. And that's very much linked to the fact that when interest rates rise, we will all see higher funding costs as issuers. Acquisition costs, I think reduced consumer appetite means that there'll be lower return on investment, but this will be offset by the lower cost channels. So as an industry, we're now seeing more than half of all acquisition coming from the digital space, and that will just continue to grow and grow without doubt. And finally, the operating expenditure. I think that will probably, again, stay the same. There's going to be a higher cost to issuers in terms of complying with all the different regulation, and the lower volumes will probably lead to a higher fixed cost per customer. But overall, I think that will stay on a parity. So this is highly speculative, and it's good to see that we don't all agree, because I think that's good that other people have a very positive outlook. But I think, regardless, whichever way we look at it, the outlook is certainly quite challenging. So where do I think the business models are going to evolve? So I've already mentioned fee income, and I think on the back of pressure on interchange, on the back of the pressure on traditional fee income, it'll become no longer viable to give certain customers all the benefits they currently get from a credit card. The 56 days interest-free credit, the rewards, all the innovation, the SMS, the mobile banking, the contactless, the personal finance management tools. Essentially, all these investments will need to see their return. And Santander's most recent sales figures almost have heralded the success of the fee-based cards. So the 123 card, which was launched in September, has sold 600,000 cards in that period. And we believe that accounts for about 80% of their sales. So there's evidence out there that customers can be accepting and will pay a fee. So I do think that annual fees will become more prevalent. I should be quite clear that I'm not saying that Lloyds is planning to introduce fees, nor am I saying will it not. I'm just suggesting that this is a prediction and this is a trend that may well pan out. So what will that mean? I think it'll mean the volume of cards in circulation will continue to shrink. So if your cards have got an annual fee, you're going to be less inclined to have multiple cards. Today, there are 31 million credit card holders in the UK, each with an average of 1.95 cards each. Last year, over 1 million cards were discarded, and we've now got the lowest volume of cards in circulation for over a decade. So as card holders become less inclined to hold multiple cards, it's going to mean that the cards are going to have to be much clearer about what they stand for. And so from a USP perspective, I think things will simplify, but perversely, they'll probably also mean that we'll have to load multiple features into a card to meet all those different customer requirements. And so the nationwide Flex card, which has a balance transfer offer, it has a rewards offer, and it has a foreign exchange offer on it, is possibly an indication in a fee-based world of the type of proposition that we might see. Who in this room has heard of the Gartner hype cycle? A handful of people. Okay, so I'll give a very, very quick summary of what the Gartner hype cycle is. And essentially, it provides a graphic representation of the maturity and the adoption of new technologies. It's split into sort of 5 phases. The technology trigger, where essentially a new technology comes out. There are early proof of concepts out there, and there's a little bit of media interest that then grows and grows and grows. We then get to the peak of inflated expectations, and that's where there is a lot of publicity in and around that new technology, and 1 or 2 of the technologies will be out there and will be tested by customers. You then get into the trough of disillusionment, where a number of these technologies fail to materialize and realize the benefits, and we start to see some very negative media and sentiment in and around that. And a number of companies who are thinking of investing in this technology then start to move out. You then move into the most exciting bit, is the slope of enlightenment. That's when people start to realize actually the true benefit of this. A number of propositions start to appear in the marketplace before moving to the plateau of productivity, where essentially this becomes a mass market and all the benefits are fully realized and it becomes an established product. So I wanted to make reference to what Gartner are thinking in reference to some of the technologies that we're talking about in payments. So the first one is cloud computing. And they very much have put cloud computing at the peak of inflated expectations. I think that's because at the moment the technology is still very much in its infancy. Yes, I think there are some stable and mature solutions out there, but at the moment, they're really quite simplistic in what they do. I think Gartner's view is that there is a lot more potential out there to integrate that more closely into everyday working practices. Contactless. Does anybody want to hazard a guess as to where contactless might be on here?
By market, UK, I'd say slope and enlightenment.
Slope and enlightenment. Almost spot on. I think it's just on the cusp of trough disillusionment. I must stress this isn't actually a Gartner one. I've put this one in because they didn't talk about contactless. But I think we've seen some negative publicity from our friends at Channel 4 and Watchdog. It is very much innovation in banking is a slow burn technology, but I do believe that contactless is getting to that moment, in particular when TfL come on board and start accepting that as a mode of payment on transport. I think contactless will really start to ramp up. Mobile NFC, anyone want to hazard a guess? No? Okay, I'll show you. This is Gartner's view. They think it's at the peak of inflated expectation. I think that's linked to the fact there have been just a select number of deployments, and at this point in time, the customer experience and business models are still evolving. I personally believe, nevertheless, that one needs to be in this space because it's only by participating and helping influence those business models will you play a role. And I think there's a strong first mover advantage in mobile NFC. P2P. So this is a little bit controversial. Again, my view, I've put it at the peak of inflated expectation, and I'm very much talking about P2P here in the developed world. The reason being, I think, is just because we've got closed-loop solutions out at the moment. They're not fully interoperable, but I think that that will grow, and I think we've put it in white. It's something that's going to establish very quickly, and I think it'll move through the curve fairly quickly. I just want to call out a few other ones that Gartner have reference. QR and barcodes. I was a little bit surprised to see that they actually see QR and barcodes within the slope of enlightenment, but it might not be such a big surprise to others. It's interesting that Apple have chosen this as their sort of technology of choice for their new passbook proposition, and maybe that could be something that will really reinvigorate QR and barcodes in the consumer market. They also talk about biometric authentication, something that we haven't seen a huge amount in the world of payments, but there are some interesting examples out there, and I was very surprised and interested to see it there. And then finally, big data, which has a little bit further to go, and I'll talk about that in a minute. I think the good thing is none of the payment technologies that Gartner called out are in the space of being 10 years or obsolete before they hit the plateau. So it's good to know that we're in the right space from that perspective. So my third prediction will come clear in a minute. But I think there are three general themes that are influencing business models in the next sort of 3 to 5 years, or maybe a little bit further. One, there'll be an abundance of computing power, storage, and bandwidth at an ever-decreasing cost, and that'll be available through the cloud. Secondly, organizations will continue to amass increasing amounts of data, and they'll be increasingly keen to do something with that data. And thirdly, social media will become even more pervasive in how we communicate with our customers. So here are a few examples of how payment providers are currently utilizing some of this technology. So firstly, we've got Bank Intander, a small but very tech-savvy bank in Spain, who are using cloud computing. They're using a hosted solution from Amazon Web Services to do all their risk analytics. So they're constantly profiling their customers and looking at where parts of their credit book could go bad, and deciding that computing power would be much more powerful and much more useful if they outsourced it. We've already heard about Gap, and we've already heard about Visa working with a number of merchants. So in the US, Visa are profiling customers when they use their card, and then sending them offers via text message to if they're close to a Gap to see whether they're interested in an offer then and there. And in fact, we're seeing a real hotbed of activity in the States. We've seen Bank of America, who've done a deal with a company called Cardlytics. Now, Cardlytics is founded by a bunch of ex-Cap One employees, and they've launched a transaction-based rewards program called Bank of America Deals. That looks at customer spend history. It looks at their online banking. It looks at spend history and then presents offers within online banking. Amex also very much looking in this space. So they have admitted they don't know how to crack data, but they want to really get into this space. So they've launched a proposition called Serve, which is a digital wallet, and they see that as a great opportunity to monetize the spend data. One of the statistics I've seen is that currently Google are paid about 80 cents for every click-through on an advert. But if they could link that directly to a sale, that value would go up to $8. So you can see that there is some hugely powerful economics here, which is why a number of players are very interested in there. And Amex are also experimenting with social media as a way to present spend incentives and offers. So they're using Facebook and they're using Foursquare to present offers. And it's their view that it's much more efficient to take those offers to where customers are rather than asking them to come to visit you and to your online banking portal. So final slide, really. Prediction 3 is that the reward market will change into this multidimensional view. So when your credit card is connected to all these technologies, you can clear out your wallet. There's no need to carry these coupons. There's no need to carry these loyalty cards. And there's no need to carry these gift cards. And I think this will in turn lead to a whole new form of reward schemes. So first of all, offers based on what you spent. So offers that are relevant, compelling, and much richer. So if you're a sort of customer that drives past a Shell every week and you constantly fill up at that Shell, then the BP across the road, they want your business. And looking at your profile, they'll probably be prepared to pay more for you if you're a creature of habit and always go to Shell than someone that might be more proliferant and go to various merchants. Secondly, I think reward will be based on the amount of influence you have. So very much linking it to customers who review products and customers who have a strong social presence, in particular online. Therefore, paying more for people who are influencers. And finally, customers will be rewarded based on their behavior. So an example might be a customer who eats well, goes to the gym, walks a lot. They could get richer rewards for their health insurance, for critical illness covers, etc. And that could be expended to a number of topics. So you could think about themes around the environment, and this would mean that a whole raft of new reward schemes, I think, will crop up, no longer reliant on individual cards. So, for example, British Airways, could measure spend with their partners, Avis, Hilton Hotels, Marriott, and others, just by looking at what's been spent on the card, rather than relying on the customer to get out their current membership card as things are. So it'll be interesting tomorrow to get the views of Nectar and Tesco and how they're using this data, whether they think this is a threat or an opportunity. But I'll just end with one cautionary tale. We're going to have to be very careful about privacy concerns here. In the US, the retailer Target recently got into a bit of trouble when it sent a number of coupons to a young teenage girl that was pregnant, and her father had opened the letter before she'd had a chance to tell him. So I think it's going to become a very interesting area, but certainly a minefield from a privacy perspective. So there we have it. Despite positive performance by the issuers in 2011, I think the outlook's challenging. The impact of regulation is going to mean that a return to annual fees is almost inevitable, but that will lead to further consolidation from cardholders. New technologies such as contactless and mobile will win out, but as always, payment innovation will take longer than first predicted, but the first movers will get certain advantages. And finally, big data and cloud technology present really exciting opportunities for card businesses to really establish themselves at the heart of commerce. So it's a really exciting time to be in payments, and thank you very much.
Okay, food.